Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. A lot of questions out there these days. We're now getting most recently information regarding trade battles once again between China and the US. There was a lot of talk about rare earth elements. What are rare earth elements? We're getting earnings season kicking off with the major banks. We're talking a lot about gold and how that can play a part in an investor's portfolio. A lot of questions I've been receiving by individual investors over the last few weeks. And as always, we want to bring all of you the answers to these questions. So let's bring up what our show has on it for today. There you have China and US trade relations take center stage once again. We keep hearing about the trade relationship between China and the US. The US seems to say, President Trump seems to say that the relationship with China is very good, yet we continue to hear back and forth. China continues to restrict certain things, and the US tends to threaten China with tariffs. We most recently heard that the United States was considering putting 100% tariffs back on Chinese imports. We'll talk a bit about that. Top three things to consider over the next 5 to 10 business days. As always, a very popular segment to our show. We're going to talk about three things that I think everybody should have their eye on before they make some investment decisions for their portfolio. Gold climbs over 4,100 at the start of the week. I don't know if anybody thought that gold would reach 4,000 before the end of this year. Gold has been on a tear. It's been doing extremely well at the, for the reasons for that, obviously, US dollar has shown some weakness. We're going to talk a bit about gold, why it's been going up, and whether you should be looking or considering adding some gold to your portfolio. What are the effects of a volatile US dollar? As I said, one of the effects of a volatile US dollar, higher gold prices. When the US dollar is weak, that definitely helps many of the things that are priced in US dollars, whether it's gold, whether it's silver, even oil. Prices tend to do a little bit better because when the US dollar is weak, the price of gold and other things that are priced in US dollars tends to get a bit of a boost. We're going to talk about all the effects that a weaker US dollar has. What weakens the US dollar? We know the US dollar has been weak, although it doesn't seem to be weak versus the Canadian dollar. Our dollar seems to be standing pat, but versus a basket of global currencies, the US dollar definitely has weakened. Should investors be hesitant investing in this hot market? Get that question asked a lot recently. People are saying, Allan, with the market's at all-time highs, how should we be investing? Should we be investing at all, or should we be on the sidelines waiting for a bit of a pullback? I think that's a legitimate question, but my philosophy is you can never time these markets, and if you have the money to invest, you should definitely look at putting that money to work. So we're going to talk about this hot market and what investors should be doing. Quick hits, as always, three things that have caught my eye in the news over the last few weeks. Want to comment on three of those things. And last, but definitely not least, your questions. I want to take as many questions as I can before we end our show. And if you have any questions, please put them in the chat boxes or send them to us. And we'd glad to either answer them on this show or during the 2-week period between this show and our next, or even perhaps on our next show. So without further ado, let's move on with our show. China-US trade relations. They've been a little bit rocky over the last few days. And, President Trump, unfortunately, when he heard that the Chinese would require companies or at least exports to obtain a license to send rare earth minerals out to different countries, the president basically was not too happy because the negotiations that have gone on up until now, the US has been negotiating to be able to receive rare earth elements. And now all of a sudden, the Chinese have said that licenses are now necessary. And President Trump recently, last Friday, I believe, said that he would be putting tariffs back on China should they go through with this scenario. So obviously on Monday, things were a little bit better. President Trump said that he doesn't see that putting 100% tariffs would be necessary, that the meeting with the head of China, the president of China, Xi Jinping, would still take place in South Korea at the end of the month. So everything was great. Markets went up. And then on Tuesday, once again, we heard some talk about China putting restrictions once again. So there's been this back and forth between the United States and China over the last few days, and rare earth materials, rare earth elements have been the basically ground zero for the discussions. We know that China produces most of what the world needs with respect to rare earth materials, and some would say that they may even have the upper hand because of this. You need rare earth materials or metals, rare earth elements for batteries, for drones, for many different things that we require in our day-to-day lives. And because China represents or makes up a large amount of this, they really can hold the rest of the world hostage because of it. And the United States seems to believe that they have, I guess, some ways to get China to the negotiating table if they were to use that as a bargaining chip. But I guess time will tell. Our first chart here shows exactly what I was just saying, how much of the imports that go into the United States come from China. You could see right here, 70% come from China. So almost three-quarters of what the United States is taking in right now comes from China. You could see that the green, I don't know if you can see it on your screen, it's a little bit small, but the green is Malaysia, 13%. Japan is about 6%, and Estonia, 5%, and everywhere else makes up about 6%. In case you're wondering where Canada sits, we do have rare earth in Canada, but right now, we're still trying to get it out of the ground and process it, whereas China obviously has been doing this for quite some time. Australia also has rare earth materials and metals that the rest of the world needs. So the hope is that going forward, Canada can use these rare earth elements maybe as a bargaining chip ourselves with the United States and perhaps provide them and be that provider of rare earth elements. Our next chart that we have here shows, who's controlling the mining and refining of rare earth elements. As I said, it's hard again to see the different parts, but you could see here that red is China, blue is the US. There are actually a few companies in the US, MP Materials being one of them, that the United States has taken a stake in most recently. There have been other companies that many believe are next that the United States government, that is, will take a stake in. And we've seen that sector really start to move higher, and a lot of the stock prices moving higher along with them. But you could clearly see that by 2040, China, which is the far right bar, the red, which is China, will still maintain their dominance. That is the projection for rare earth elements, the refining and the mining of it. Both look to be mostly China and what they will be able to do. Our next chart here is actually of our map of Canada, and you could see here all the different things that are going on in our country right now. But you could see a lot of the things are active, but still not at the stage that China is at with respect to rare earth materials. All the dots represent activity. You could see processing, feasibility, primary economic assessments being done, resource estimates, etc. Those are your orangey boxes, and then you look at the green. That's the active mines that were active with respect to rare earth. Our next chart we can show up, and this shows all the different things as a country that we produce: the coppers, the lithiums, the potash, phosphorus, the nickel, the cobalt, the zinc. Our country is rich with different metals and rare earth elements, and that's really what I think many are calling for. They're calling for our government to be able to cut the red tape so that we can unleash these elements to the rest of the world, to be able to trade and have a good, maybe even an upper hand with respect to trade with the rest of the world, because a lot of the world does not and do not currently produce what Canada does with respect to materials and metals and mining, not to mention in the gold and the silver, a lot of copper, aluminum, all the things that the rest of the world needs, including the United States. We know that the United States has put tariffs on our aluminum, our steel, copper, even our energy, and our uranium have tariffs on them for about 10%. But right now, they're saying 50% tariffs on things such as steel and aluminum. I'm wondering how long this is going to last. Obviously, this is a negotiation that's been going on with the Prime Minister, going down to Washington, I believe, within the last week or so. And we still have not heard anything as yet. So you can clearly see that even though China dominates the world with respect to rare earth elements, rare earth materials, Canada at some point, hopefully, will be able to join the party with respect to those elements and provide the United States, perhaps the rest of the world, many of the elements that it seeks today. Top three things that individual investors should be focusing on before they make their investment decisions. And as I said off the top of the show, a very well received part of our show. I get questions on this all the time, asking just exactly how I come up with these ideas and why they are top of mind, or why they should be top of mind before individual investors make their investment decisions. So what do we have for our show this week? Number one, key U.S. bank earnings. We've already received a number of bank earnings. I think very, very important to give us an indication how the U.S. economy is faring. Obviously, with the U.S. government being shut down, I think bank earnings give us a pretty good glimpse as to how the economy is faring. Number two, despite U.S. government shutdown, the CPI data. This is an inflation measurement. Inflation measure is going to come out Friday, October the 24th. That is next Friday. So yes, the government did come back, or is coming back long enough, or for enough time to gather this information on inflation. And it's going to be a key and perhaps a market mover. We're going to receive data that will tell us, is inflation still at that 3% rate? Has it gone higher? Has it come down a little bit? This will be a key measurement for the Fed to decide if they're going to continue to cut rates and how quickly they will cut rates. Will they cut a quarter point more, or will they cut maybe 50 basis points, 1/4 point cut at each of the next two meetings before the end of the year? Maintain reasonable expectations. This to me is extremely important because I think expectations have gotten a little bit out of whack for certain investors. Making 10, 15% just isn't good enough anymore. We've seen the markets gaining so much over the last, let's call it 6, 7 months, coming off their lows and now at basically all-time highs, that I think individual investors have been sort of, getting used to it. And when you come in with more normalized returns, normalized from the standpoint of historical values, individual investors are just kind of yawning or saying, well, that's all we can make at this point. So we just got to be careful about our expectations. So let's move to our first topic, which is key U.S. bank earnings. And we can move to our first chart, and that's one of JP Morgan. And you can see JP Morgan has had a phenomenal run, an unbelievable run. The actual stock is closing in on a $1 trillion market cap. Yes, it would be the first bank in North America. Obviously, JP Morgan's the largest bank in North America, one of the largest banks in the world. First bank in North America to reach 1 trillion in market cap. Still have a little ways to go, but it's been on a great run. And why not? We just received numbers from JP Morgan the other day, and they were phenomenal, unbelievable in every respect, And net interest margin, maybe a little bit weak. What net interest margin is the gap between what they pay for, GICs, or what they would call in the US CDs, to term deposits, what they would pay when you leave money at the bank versus what they charge you when you take out a loan. So it's the difference between what they charge and what they make. Net interest margin was a little bit disappointing, but other than that, everything from trading to wealth management to they call it FIC trading, which is the all types of trading, fixed income, commodities, everything was great. We saw the IPO market doing extremely well, probably the best IPO market we've seen in the United States really in many years. Again, a name like JP Morgan benefits from that. It's just been a great run. Loans, again, no matter what you looked at, right across the board, JP Morgan, they beat on the expectation. The stock actually fell a little bit because heading into the number, they were up something like 28% for the year. So very difficult. They had a high bar to beat. They beat on top and bottom, but I guess the market was taking it in stride. And when they released their earnings, the market actually sold off the stock a little bit. But I think that will rebound and the stock will be just fine. Next stock that we have is Bank of America. Again, Bank of America, another big bank stock. Earnings are good. Everything is solid, taking in a lot of money into their savings accounts. We often hear from Bank of America, they're a pretty good indicator as to how the consumer is faring. They have a unit of Bank of America that studies the consumer. And even though they may not be spending as much, so they have told us that recently, they're still saying the consumer is extremely strong. So Bank of America, just like the other banks, has done extremely well, fallen off a little bit. You can see on the right-hand side of that chart, but still sitting just under $50 a share. Goldman Sachs, our next chart, again, phenomenal earnings. They make a lot of money on trading, a lot of money on trading and investment banking. That is where Goldman excels. And they definitely excelled this go round. They had a bit of an issue with respect to expenses. Expenses were a little bit higher this quarter than anticipated, but make no mistake, another phenomenal quarter for Goldman Sachs. And our last chart here is Citibank, Citigroup, and Citigroup now again right across every sector of their business, every part of their business is doing well. All the international markets doing well. It was just a blowout quarter, and the stock on the day they reported actually was one of the best performers of the U.S. banks. They reported at the same time as Goldman, as J.P. Morgan, as Wells Fargo. Wells Fargo also had a great earnings report. We don't have that chart for our show today, but Wells Fargo, like Citigroup, had a great day on the day that they reported. So what does that tell us for the stock market or the economy? I think it says the economy is doing just fine in the United States. I think the economy is doing well. I think the consumer is doing well. We keep hearing that Bank of America, from Bank of America and other banks, that the consumer is still spending. You know, JP Morgan CEO Jamie Dimon has said recently that he's concerned that things may slow, but he always takes a bit of a cautious tone. And maybe that's also why the stock of JP Morgan was down earlier this week when they reported. But make no mistake about it, if the US banks are telling us anything, they're telling us that the US economy continues to be strong and these US bank stocks continue to climb. And for the most part, they're starting to get a little bit pricey, but I think you can still pick a couple of those names, like a Citibank that's only trading at 1 times book value. So book value is basically the bottom price. If you were to strip out everything of the bank, what would the bank be worth? That is what their book value is. And they're trading just above that. So still not getting a premium for a fantastic business over at Citibank. Our second topic that individual investors need to be focused on before you make your investment decisions is the inflation data that we're told, this is what we're told, is going to come out next Friday. There obviously are no guarantees, but if it does come out, it will definitely, well, it can be a market mover. If it comes out basically in line with where the other numbers have come out most recently, then it may not have much of an effect. And what are those numbers? Our first chart will show us. In the US right now, you're looking at a CPI rate, core rate of about 3.1%. The headline number is just under 3%. If you were to look at PCE, another indication of inflation for the Fed, personal consumptions and expenditures, you're seeing that's coming in at around 2.7. So I think it's safe to say right now that the inflation rate in the United States is in at around 3%. far away from that 2% that the Fed would like to see. And again, we'll see what this CPI data looks like come next Friday. I thought it'd be interesting to show our next chart because that actually will show what the Canadian rate is. If everybody or some of you may have forgotten, the Canadian key interest rate, inflation rate, we can show that our next chart. Bank of Canada's rate, there it is. You can see our Bank of Canada rate, 2.5%, and the inflation rate, 1.9%, which is, I think, still gives us room, gives the Bank of Canada room to cut rates, and I think they should cut rates. Make no mistake about it. I've said this a number of times. I think the Bank of Canada should cut maybe even two more times before the end of this year. So hopefully they're listening and hopefully they'll agree with me, stimulate our economy. We need to get rates as low as we can. And cutting taxes wouldn't hurt either, as I've said many times. So CPI on Friday, not this Friday, but next Friday will be key for individual investors. Our last point that I wanted to talk about before you make your investment decisions is really being grounded in your expectations. We need to keep reasonable expectations. I think in some ways expectations have kind of got out of whack a little bit skewed to the upside. And why not, right? We've seen tremendous gains this year and even over the last few years. And I thought it'd be interesting to see exactly where we sit with respect to how things have been recently versus the averages. What is the average for the TSX and for the S&P 500? And how do we compare over the last few years? Our first chart actually shows what direction the stock market will be over the next 6 months. It basically gauges, a direction for individual investors, whether they're bullish, whether they're bearish, or whether they're neutral. You can see the gray is neutral, the green is bullish, and the red is bearish. Numbers don't really change an awful lot. They are moving a bit to the upside on the bearish side and maybe slightly to the downside, to the bullish side, to the upside on the bullish side, and slightly downward on the bearish side. Neutral kind of stays roughly where it's at. So it looks like people are getting more bullish, which is maybe for those contrarians out there, maybe it could be a contrarian indicator, and some may be selling into this bullish sentiment. Our next chart here shows exactly what I was referring to. The S&P TSX. So the TSX total returns. What is the average for the TSX over the last, let's call it 1948 to 2020? You're looking at 70 years or so. What is the average? And for the TSX, that average comes in somewhere around 7-ish%, 7.5, maybe 8%. You can see here the middle graph, the middle bar there is the 0 to 10%. You can see that is the highest that it goes to, and most years it falls within that 0 to 10. On either side of it is slightly below, but overall you could see that the TSX averages somewhere around 7%. Well, I can tell you this year the TSX is over 20%. Last year it didn't make as much, but still above average. So we've been getting above average returns on the TSX, and that probably is one of the main reasons why expectations have been so high. Let's move on to the S&P 500. The S&P 500, there it is. What is the average for the S&P 500? Well, you can say it's somewhere around 10%, plus or minus a little. And again, that large bar, if you will, which is cut up into all the different years, that is the 10 to 20% mark. And I would say it's probably closer to 10% than it is 20. That has been the average for many, many years. In fact, I believe when I first started in this industry about 26 years ago, average was probably closer to 8% than 10%, but it has definitely moved higher to 10% recently. And over the last 3 years, I would say the average has probably been closer to 20%. The averages have basically doubled the average for the previous 70 years. The last 3 years has been 20% on average for the markets, maybe a little less, maybe 17, 18, but in and around that area. And this is why individual investors, I believe, their expectations are starting to get a little bit to the upside, skewed to the upside. And I think that if we can still maintain that 8 to 10% rate of return on an annual basis, that is what we're striving for. That means you're going to double your money every 7 to 8 years, 7 to 10 years, and that should be what everyone is looking for. Our last chart here shows a nice comparison between the S&P 500 and the TSX. And you can see, yes, the S&P has outperformed, but not by a lot over the last, I think this is a 5-year view. It's only outperformed by less than 10%. So even though the S&P 500 has outperformed recently, if you go back over a period, I guess that would take us to 2020 COVID times or just slightly before, the S&P and TSX haven't deviated an awful lot. So main message for me is not so much to you want to make obviously as much money as we can, but you need to have the right expectation. We can't be greedy. We need to take our wins when we have them, trim those profits, move money around, take a winner, perhaps take some profit off the table. Don't just let it all ride. I don't think that is a great strategy. It's not prudent, and it's not the strategy that I would use. Take some money off the table, move that money around into other areas. And I think that is what individual investors should be doing, letting it all ride and taking a chance that perhaps a certain investment might pull back. That is a bit on the higher risk side and definitely not a strategy that I think many investors will follow. So overall, I think you want to keep the right expectations in mind, keep an eye on inflation, and let's look at or continue to look at key bank earnings. We're still going to get a few more bank earnings that are coming out, and let's not forget Canadian bank earnings will be coming out next month as well. So if you can keep an eye on those three things, I think that will go a long way as you continue to build out your investment portfolio over the short and long term. Gold climbs above 4,100. It is the first time we've seen gold above 4,000 an ounce. Not sure if anyone would have predicted that, to be honest. It's been an unbelievable run, and definitely the chaos in the US, the uncertainty around the world, wars, weaker US dollar, all that has played a factor. High debt levels, not just in the US, but all around the world. It seems like countries are taking on more debt to spend to try and stimulate their economies, and that's what's happening right now. And the benefactor of all the spend and all the debt levels has been gold. And our first chart here we can see is of gold, and there it is. And gold just does not seem to want to stop over $4,100 an ounce. It still is quite volatile. We've seen gold just in the last week or so fall $100 an ounce, only to rebound $50 an ounce the next day. It still is, in my opinion, a higher risk investment, and one that is definitely not for the faint of heart. For those that are betting on a weaker US dollar, more US Federal Reserve cuts coming up, then gold is and has been and continues to be a good investment idea. As many of you know, I'm not much of a gold bug. I still can't get over this idea of what owning gold actually does for somebody. If you own some gold bullion, you put it in a safety deposit box. What's that for? Is that for the end of the world scenario? We all know that you can't take a bar of gold and go to your local Shoppers Drug Mart or variety store and buy groceries, or go to a grocery store and buy groceries for that. So what can gold do for you? Well, I guess it's a hedge against the US dollar, but it's mainly, in my opinion, a trading vehicle. People are using it to trade right now because of the weakness in the US dollar. Because of that, and that's probably the number one reason that individual investors are buying gold, for a trading vehicle. Our next chart that I actually wanted to show is one that compares gold, and this is actually going to be a chart of Bitcoin. And I thought it'd be interesting to see cryptocurrency. How is crypto faring? Is it faring as well as gold? And the answer is yes. Crypto or Bitcoin is doing extremely well as well. Again, is that because of the weaker US dollar, for individual investors trying to find an alternative to the US dollar? Well, perhaps it is. We all know that when it's a risk on type of day in the markets, Bitcoin tends to do well, like the stock market as well. So, wanted to show Bitcoin for all of you out there that are wondering how Bitcoin is faring. We saw the chart on gold price, but Bitcoin as well. Analysts, let's show our next chart. What are analysts saying about the price of gold? Well, again, well, you actually can see it here. We blew it up for you here, but I have my notes here that I can see. You can see all the different banks talking about where they believe the price of gold is going to end up in 2025 and where they see it for 2026. Bank of America believes that at the end of 2025, they had a $3,300 target. Well, that's way past that now. They actually had a $4,400 target in 2026. We'll see. That's a little bit away, maybe another $500 an ounce away. But a lot of these analysts actually have lower targets for the price of gold. You're looking at Deutsche Bank, 3,200, 3,300 for the end of 2025. HSBC, even Goldman Sachs. But many of these investment firms and banks have a much higher price for gold for 2026. You can see here Goldman Sachs, 4,500 an ounce for the yellow metal, and the Bank of America, they just hiked their gold price for 2026 to $5,000 an ounce. So some are betting against gold, some are betting with gold. For me, I've never been one to bet with gold. I believe that the yellow metal will come down as the US dollar gains strength, as the US economy gains strength, and as we start to see a little bit more consistency, all this negativity around trade, trade US China, US Canada, US rest of the world, all this uncertainty, all this debt. I think as the situation gets better, I think you could definitely see the price of gold fall. And to me, when you own gold, it's something that you just don't sit on. Maybe as a small piece of a portfolio you can hold for the long term. But if any of you are holding gold as a main component for a portfolio, definitely you want to keep an eye on what's going on out there and how it affects the price of gold, because the yellow metal is definitely something that can fall or move a lot higher very, very quickly. What are the effects of the US dollar? Something we don't talk about quite a bit on our show. The US dollar, what affects the US dollar? We've talked about it throughout this whole show, right? Higher debt levels, uncertainty, geopolitics, the political climate, US shutdown. I believe that is also having a negative effect on the US dollar and helping things such as gold and other things that are denominated in US currency. So US dollar is very important. US dollar is important for multinational businesses that do business in other parts of the world. Why is that? Well, if you're a company like Caterpillar, for example, domiciled in the United States, you do business all over the world. And whatever that business is, it's done in those local currencies. And then when you repatriate that money back to US dollars to be able to claim how much you made over the past quarter or year, you have to report that in US dollars. So if the US dollar is weak versus other currencies, that gives your earnings a nice boost. If the US dollar is too strong, well, you could see that your earnings will come down because of that strong US dollar. So a US dollar has a big effect on all of us living in Canada, living in Europe. Obviously, those trips to Buffalo that everybody takes from Toronto and from Southern Ontario, or trips to the US in general that Canadians make become a lot more expensive when the US dollar is stronger. Lately, as I said, US dollar has shown weakness versus a basket of currencies around the world. Our first chart clearly shows this. Let's put up that chart. But as I said earlier, actually, we can put up the chart first. As I said earlier, there it is, you can see the weakness in the US dollar. But as I said, the Canadian dollar has not fared too well as well. And so the US dollar actually has maintained its value versus the Canadian dollar, but versus other currencies, it has definitely lost a lot of value, especially versus the euro. Those that are buying euros lately with US dollars, they're finding it quite expensive. Let's go back to the chart that we put up just briefly, and we can show the US dollar importance. Key takeaways: the US dollar is an official currency of the United States and many other countries or many other territories. US dollar is considered the world's most stable currency and is used extensively in global transactions. We know that. US dollar, especially in emerging markets, is huge. US dollar weakness is very important for the emerging markets. The dollar was delinked from gold in 1976 after a lengthy process beginning in 1933. On 88% of the world's forex trades, US dollar plays a pivotal role alongside being a global reserve currency. Discussions regarding the US dollar diminishing international role persist, but it remains strong due to the US economic stability. So yeah, we've heard the BRIC nations, Brazil, Russia, India, and China talking about lately moving away from the US dollar, perhaps coming up with their own currency to be the backing of trade and many other things. But that still is not the case. The US dollar continues to be the mainstay for the world. And even though countries like China want to move away from the US dollar, they buy gold. They've been buying a lot of gold to diversify away from the US dollar. The US dollar still remains the dominant currency around the world. Our next chart here shows gold prices with respect to or versus the US dollar. You could see towards the end of that chart, you could see the US dollar falling and gold prices surging even higher. And that goes with what I said in our last segment, that gold will move higher when the US dollar shows weakness. Our next chart shows debt levels. What are the debt levels? We know that the US dollar is weak when the US debt moves higher. And oh boy, the US debt has moved extremely high over the last few years. During the Biden administration, a lot of people are fearful that even during the current administration, President Trump, that the debt levels will continue to surge, and that is not good for obviously debt and US dollar. US dollar being that reserve currency, the US economy. So higher debt levels just adds to the uncertainty, which continues to weaken the US dollar. So moving forward, it's definitely interesting to keep an eye on the US dollar, keep an eye on what's happening with respect to US government bonds. That also goes hand in hand with the dollar, the strength in the dollar, strength in the economy, GDP growth. All that plays a part with respect to the US dollar and how Canadians, when we travel to the US, how we will fare, how far our dollar, our Canadian dollar, will go versus the US dollar. So definitely something that I think many investors and just individuals in general are keeping an eye on moving forward. Should investors be hesitant investing in a hot market? And as many of you know, the way I answer that very simply is no. We can't time markets. You should never try to time markets. I understand that the market is at all-time highs, but now's the time where good investors, investors that do their homework, that do their research, you will find and continue to find those investment ideas that are still relatively cheap. And in those investors that try to time this market, go to cash, sell out of your winners, sit on cash and wait for that pullback. Those are the investors that end up not making as much in with respect to returns as other investors that just keep their money in the market. But yes, you can move it around. You can trim your winners. You can buy some of the names that have not moved up as much as yet. Or perhaps you want to buy some of those names that have pulled back for reasons that aren't, in my opinion, valid and that perhaps have nothing to do with that business whatsoever. We see it all the time. Geopolitics. When the political environment is negative, stock market tends to pull back. But that has nothing to do with how Meta is doing. That has nothing to do with your shares of CIBC or TD Bank or CN Rail. When the political climate is negative, unfortunately, investors are negative and they pull money off the table. But that tends to be a good buying opportunity. Buy the dips, as we say. That seems to be the motto for many investors over the last bunch of years. You buy on the dips because this economy in the United States, I should say, their economy is doing extremely well. Our first chart actually is made up of two charts. And you can see here on the left side, good days in the market. Well, if you're somebody who's pulling out of the market, and not sure when to get back in, and you're trying to time this market, you can see when good days happen. Most of the good days, 50% of them, happen during bad markets. So if you're an investor that is trying to time this market and pulling out of a market that you may think is going to become difficult or is already starting to be difficult, you might miss on half of the good days of the market. And you could see that during a bull market, 22% of the best days are during a bull market. And during the first 2 months of the bull market, you could see that even a little bit more, 28% of those good days. So never a good idea to try to time markets. And what I tell people is, yes, we're always waiting for that shoe to fall, that the stock market to fall, and you're just not sure when that is going to be. However, what are you going to do? Are you going to wait on the sidelines and just have your money in cash and watch that market go higher and higher each day? And then eventually, yeah, you will be right, but perhaps you leave 15%, 20% on the table. And yes, maybe the market then pulls back 5 or 7%. So the average investor that stayed in the market makes 13%, 20, and then they lose 5 to 7. Whereas the investor that pulls out of the market maybe keeps half their money in the market. They don't make as much, but they're still in for the losses as well. So my advice is the bad markets and the difficult times will always happen. What we want to do is we want to take advantage of the good times, take advantage of those good times when they're here, like now, for example, and then minimize the loss when markets are more challenged and in difficult times. And I think if you can do that, that is the recipe for success. If we can just bring back our chart again, we can show on the right-hand side of that chart, you can see if you're fully invested, that is the best way to be for all days and not try and time the market. You can see what $10,000 would grow to if you invested from 1995 to 2024. This is basically just under 30 years. You could see how much you would have made had you missed just the 10 best days. You would make 54% less. Had you missed the 20 best days over that 30-year period, just 20 days, 20 best days, 73% difference, 73% difference in the person who stayed in the market versus came out. And obviously, if you missed the 30 best days, you 83% less at the end of those 30 years than you would have had you stayed in the market. So very important not to try and time this market. We want to stay in this market. We want to move things around. We want to take some profit and keep investing those profits into things that have not gone up yet. But that is the strategy to use, and not take your money fully out of this market and wait for better days ahead. Quick hits, 3 things that I've seen in the news over the past couple of weeks that I wanted to touch on. And some of you may have heard of some of these things. Bank of Canada Deputy Governor says competition in Canada's financial sector will boost productivity. Something that I've been saying for quite some time. We want more competition, not just in the banking industry, but in the telecom industry, maybe even the dairy industry should have some more competition. So that's what our Deputy Governor said about the financial industry. JP Morgan will invest up to $10 billion in U.S. companies with crucial ties to national security. That is quite large. And Jamie Dimon has said recently that they need to invest more money in these crucial areas, defense, rare earth materials, all the different things that President Trump has said that the U.S. should be doing. Bank of Canada should keep cutting interest rates despite job gains, some economists say. Some economists say, I say as well, we need to keep cutting rates. We need to make things more, a better environment, more productive, and just a better environment for people to do business in our country. So our first topic here, what the Bank of Canada Deputy Governor said, and really she made a quote. We can put up the quote, and the quote reads there it is. As the world heads into a period of greater economic nationalism and more industrial policy, we need to resist the urge to add protections. Instead, we should look for ways to encourage more innovation and greater competition. I focus my remarks today on the financial sector because it fits with the bank's mandate and my own background. This is her talking, of course. but there are other sectors of the Canadian economy where more competition would contribute to productivity and growth. Couldn't have said it better myself. And that is what the United States would like to see us do: open up our sectors, our economy, and perhaps we would see cheaper pricing for our phone plans, cheaper pricing for dairy products, cheaper pricing for many things that the competition is kept out of. We do have Canadian banks, sorry, we do have international banks, US banks here in Canada, but they're here on a small scale. And yes, some of our US counterparts, our US businesses have come up only to leave Canada, such as Disney, such as Target. Some of the retailers just couldn't cut it up here in Canada. But overall, I agree with the Bank of Canada, the Deputy Governor, and we should open up our industry more. The second topic that I wanted to touch on that I saw in the news most recently is the idea of JP Morgan and spending up to $10 billion in US companies. And they basically go along, I guess, with what the current administration is saying. They don't want the United States to be held hostage when certain things could happen. We saw it during COVID, the pharmaceutical industry, a lot of the drugs that were made outside of the United States. The equipment that they needed during COVID was made outside the United States. Then you have the rare earth materials that, as we said earlier in the show, predominantly coming from China. This is what Jamie Dimon, the CEO of JP Morgan, was saying, that they want to invest up to $10 billion in these types of things. They call it the defense industry. Defense, that's another thing, right? Defense with respect to drones and with respect to military, that obviously is what Jamie Dimon is saying as well. So look for JP Morgan perhaps down the road to make some announcements with respect to that. And last but definitely not least, one of the topics that touches home with me is this whole idea of continuing to cut interest rates. The Bank of Canada should continue to cut interest rates as we move further ahead. And we can look at the interest rate, Bank of Canada policy interest rates, which are right there. You can see the cuts that have happened, the recent cuts of a quarter point in September. Hopefully, it'll be followed by a quarter point at the end of October and another quarter point in December. And I think that could set the stage for a rebound in the housing market. We know that the housing industry housing builds are slowed. There's really not much building going on at all right now. Builders are not building. The economy is slowing. We need to make things as good as possible for businesses to survive and thrive. And so I agree with these economists. I think and I believe that the Bank of Canada should continue to cut rates, and I think they will. I think they will cut rates at our next meeting and maybe even in our last meeting of the year. What's my take? Well, this is the part of the show where I take at least one question from the audience that we received during our show over the last couple of weeks. And I thought this one is interesting. It's come up lately a little bit. And it says, both President Trump and the head of the Toronto Stock Exchange have recently spoken about firms moving from quarterly to semi-annual reporting. How will this shift impact investors? Well, if they actually go to semi-annual reporting, I think it will impact investors quite a bit. We seem to, and I include myself, so I say we want to have as much information about businesses as we can. The more businesses tell us about how things are going, the better we can make our decisions with respect to making investment in that business. If we go to semi-annual reporting, then that will not give us as much information as we've had. Some businesses today tell us a lot on a monthly basis. Taiwan Semiconductor, for example, the biggest global chip maker. NVIDIA is the designer of the chips, and Taiwan Semiconductor builds the chips for NVIDIA. They give us numbers on a monthly basis, and that's great to see. We get a glimpse every month into how many chips Taiwan Semi has made, where they've made them, and how the business and the semiconductors and the tech industry are faring. And that's a great thing for investors. If we go to semi-annual, well, We're just going to have to find ways to get information to help us make informed decisions. So, getting to this question, how will this impact investors? I think it'll impact us a lot. And my hope is that they do not go to semi-annual reporting. I hope they stick with the quarterly reporting. I love quarterly earnings season, and we're about to start one right now. We just had the big banks in the US kick off this quarterly earnings season. So with that, I want to thank all of you for joining me on our show today. Hopefully you were able to take away something from our show. I wanted to say that we will be back on the air once again 2 weeks from today, October the 29th, which is obviously a Wednesday at 12 noon. And until then, happy investing.